Hello, welcome to BQ Prime. You're watching Q1 with BQ, and my company in focus today is Kalyan Jewelers. It's a South-based jewelry company with pan-India presence. And joining me is Ramesh Kalyanaraman. He's the executive director at the company. Ramesh, thank you very much for joining us on BQ Prime.
Thank you.
To begin with, Ramesh, how was the first quarter revenues?
Yes, so Q1 was extremely good. The revenue grew by 34% in India. On a console, it grew by around 31%. Strong momentum across all geographies, including India, Middle East. It was continuing throughout the quarter, right from April first week, Akshaya Tritiya, and way forward. The PAT has grown more than the revenue. The revenue growth was around 31% console, and PAT grew more than 33%. So, doing the expansion plan is also on track and all doing well.
I understand that the Q1 was positively impacted by the Eid being there, and that would have bumped up the revenues. But do you see the similar kind of revenue growth coming into Q2?
Yeah, so Eid, the revenue which would have preponed in Q1 is majorly Middle East, because Middle East Eid is a 1 week, almost a week of a holiday, and that got absorbed in Q1. But India, the momentum was strong even without the Eid. The Eid is not the major factor why the India revenue grew.
Okay. What about the expansion strategy? Because you've taken an aggressive expansion strategy as far as franchise opening is concerned. Can you take us through that strategy for us?
Yeah, so this year we had announced 52 new showrooms, and all in the non-South markets. And now, as we speak, we have already opened 14 showrooms now, and we will be opening 10 more showrooms in the month of August. We will be opening most of the 52 before Diwali. That's our plan, because we get 2 major seasons after that. And this is only Kalyan Jewelers India, and we have expansion plan for Candere, our digital platform. Now we have only 2 physical stores, but we want to end at least 30 showrooms before the end of the financial year. The expansion will start from the month of August on Candere. Middle East, we are opening our first franchise showroom in this quarter, and once that settles down, we will come back to you with a Middle East expansion start.
Franchisee model work in terms of bringing in margins and revenue?
You mean the existing franchisee showrooms?
Existing and new franchises, how does it work? What is the business model there for you? What kind of margins that you get compared to your own store margins?
Yeah, so it's a FOCO model wherein we share a part of gross margins with them. The gross margins, of course, will have lesser gross margin when compared to our own store, because we share a good percentage of gross margin with the franchisee partner. Franchisee invests on inventory, and the ROCE for all additional new showrooms are in the range of 75% plus. So there will be growth in PBT as a percentage. There will be substantial growth in ROCE, but there will be a degrowth in the gross margin as well as EBITDA margins, because there is a gross margin share which we do with the franchisee partner.
What is going to be the mix of own stores and franchisee stores going forward, and what could be the stabilizing gross margins that you will be working on? Because as franchisee increases, your gross margins will come down. So what is the level of gross margins that you will be more comfortable with, and the mix of franchisee and the own stores?
Yeah, so this year all the stores opening plan is with the franchisee, and so there will be pressure on the gross margin. So we should estimate a 0.5% gross margin degrowth every quarter going forward, because all the expansion plan is based on FOCO model. So, and this year and the next year also we plan for FOCO model franchise, and our focus is on PAT and ROCE, and not gross margin and EBITDA, because that's anyway going to degrow because of the franchising model coming.
So what will be the level of gross margins? Because you had a gross margin of 15.1%, and your own store gross margin was around 16% or so. So
Yeah.
What is the level at which the gross margin will stabilize?
Because franchisee gross margin is in the range of 8.5%. Okay. And our own store gross margin is at 16% as we speak. So when the franchisee stores number go up, the gross margin as a percentage will surely come down. So we estimate that at least a 0.5% gross margin degrowth in every quarter going forward, because franchisee stores increase that way.
Hmm. Give me a sense of what's happening in the non-South market, and also we understand that this year the plain gold jewelry, this quarter plain gold jewelry growth was much more than studded. Uh, so that would have also contributed to some kind of pressure on the margins, right?
No. Studded growth was much higher than the gold, and there is no pressure on gross margin at all on a retail level. The pressure which you see on the gross margin is only because of the franchisee revenue coming. And of course, yes, gold had better demand in the Middle East because of the Eid 1 week sale. That week, gold demand was higher, and that is why there is a degrowth in margin in Middle East. But India, we don't have any pressure in margin, and we have only improved YOY in our retail stores. The margin degrowth which you see is only because of the franchise revenue coming.
How do you see same store sales growth going into FY24? Means will it be as good as what you saw in the first quarter, or going to be some muted coming in?
No, for Q1, the SSG was very strong. It was in the
Yeah.
range of 15%. Okay, but always we should estimate a 5 to 7% SSG. That's the way we should look at it. But whatever comes beyond that is good for the brand and good for everyone.
How are you looking at the GML limits increase, because gross gold gold loan or what called GML has been an issue with, right? The limit has not been able to go up. So how are you looking at that?
No, so the gold loan, we are at the 1,800, 1,850 range. Okay. Our objective for this year and the next year is not to increase the gold loan portion, but to reduce the CC limit so that the percentage of gold loan over the total exposure goes up. Because we go with the FOCO model expansion, and there's going to be a lot of cash in the book because our expansion is completely taken care by franchise. And we will reduce at least 15% of our gross debt
That would be
this
how
year
much
as well.
actually?
So it
15%?
will be in the range of what, 300 crore?
Okay. And
Yeah.
what will that lead to in the cash credit limit that you are looking to increase?
No, cash credit we don't increase, we reduce.
Okay,
So gold loan as a percentage of the total exposure goes up.
goes up. Okay. So how does it work out for you? Means if it goes out, will you be able to push more products out and or take more imports in? How is it actually?
So you mean we do not what do you call, you're talking about export? What did you
I'm
ask?
talking about if GML limit goes up because
Yeah,
you're going to reduce your cash credit, how will how will it impact your business?
no, nothing gets impacted.
In this,
Gold
in a
loan,
positive
we are
way, means how does it what kind of reflection that will be there in the operations?
now the interest cost comes down because we are reducing the exposure of CC, which is at a higher interest rate than the gold loan. So interest cost comes down, and again ratings go up, and we can take out certain non-core assets which is there, which has been mortgaged with banks because of the CC limit that comes out, which can be again liquidated and brought into the system, which again lightens our balance sheet. So that is the way we should look forward. It's a 2 to 3 year mission where we will lighten our balance sheet because of all these actions which we take.
What is the kind of free cash flow that you will be able to generate during that period as you move to away from your own stores to franchise model? There will be additional free cash flows that will come in. What kind of free cash flows can we see coming in every year?
Yeah, so it should be in the range of 400 crore plus.
And that would be the one which, and how will you use that cash flow, whether for more aggressive expansions or capex, or is it going to be to delever your balance sheet more?
So yeah, so as I told you before, most of that will be for repayment of debt. But again, we have to increase our inventory levels because we have to keep 10 to 15 days of inventory for our franchisee operations as well. There will be some investment onto the capex because we take the capex for the franchisee stores. So total cash generation around what 40% we will use for debt reduction. So total cash generation will be in the range of 700 crore, out of which maybe 300 crore will go on to reduction of debts. And you know that we have declared dividend as well. So a portion of money has to go in for repaying our, meaning paying back our investors as well.
Okay. Give me a sense of expansion in Candere because you're talking about some 30 odd stores, if I'm not wrong,
Yeah,
expansion.
yeah.
Uh, but Candere is also losing money in terms of it's a loss making. So, how do you plan to ramp up Candere as well as bring in profitability there?
Yeah, so Candere, as you have seen, we acquired Candere in the year 2017. Okay, right from that time, it has been an average CAGR growth of around 60% on revenue. It became profitable, and then now it's taking a next transition phase wherein we have to add physical stores. We have to again invest on technology, and this transition phase, I think, will get settled down by the end of this financial year, and from next year you should see surplus in Candere again.
So, it should turn profitable next year onwards. That's what you're saying?
Yeah. Yes.
Okay. Give me a sense, my understanding is that you're also looking at importing gold under CEPA agreement. Well, what's happening there and by when will you be able to do that?
And we are also working on CEPA. I think maybe by Q3 we will be able to take the first lot of CEPA. That's what we are targeting for. We
Okay.
have the allocation in place. Yeah.
And everything in so how does will that benefit you in any way, means in this, how does it benefit you, the benefit flow in for you actually when you go through CEPA?
Now 1% import duty exemption is there for CEPA gold. That is our major benefit.
Okay. uh, Ramesh, my final sense is that your entire expansion strategy is based on franchisee now. Uh, have you abandoned own store growth as well, how is it actually?
No. Like I told you before, we have a 2 to 3 year mission wherein we want to lighten our balance sheet a bit. Okay. And that is why we are not allocating our cash into expansion. We don't want to sacrifice growth, and growth will come up through franchisee partners, and the free cash flow will go on to reduction of debt, which will take out our non-core assets from the book. We can liquidate it and bring it back to the system, which will again lighten our balance sheet. So that is a 2 to 3 year mission. Post that, of course, we have to open our own stores as well, because again the balance sheet will be heavier if we don't allocate that cash anyway.
Okay, so for the next 2 years at least you are going for a franchisee model, and then you may re-look at the store strategy
Yeah.
going forward.
Yes. Yeah.
Ramesh, it was a pleasure talking to you today. Thank you very much for joining us on
Thank you.
BBK.
Thank you. Thank you very much.
Bye.